Hello there, Adam Gower here, and I build digital marketing systems for real estate professionals so you can build your investor list, find more investors, raise more money, and do more and bigger deals. Find out more about what we do over here that can help you by going to GowerCrowd.com. And right now, welcome to our podcast, Syndication in the Digital Age, with today's guest, Kam Zainabadi of Park Place Investments. Now, Park Place Investments, I can't remember how they first came across my radar, but I think Kam wrote to me to put a notice in one of our weekly newsletters about a deal they're doing. And so I took a look at it. I was fascinated to learn that he has set up a crowdfunding platform. Now, this is a very interesting platform. You're going to learn all about it today. Most of the platforms that you will find online at the moment have a very heavy curation component to the deals that they put up there. And so it becomes increasingly difficult for sponsors to post their deals on a crowdfunding platform, right? The standards for qualification have become increasingly high. And so as a result, what you find is that 99.9% of sponsors who would like to raise money on a crowdfunding platform are unable to. And so what Kam has put together is a platform where nearly 100% of sponsors can list their project, and caveat emptor as far as the investors go, but heck, why not? You really should be taking responsibility for your own investment decisions no matter where you try to find a deal. So you're going to learn a lot from Kam today about his platform. And if you want to raise money online and you're thinking about listing on a crowdfunding platform, that is not always the shortcut to raising money. You still need to have a very strong online presence of your own. So if you want to raise money and do bigger and more deals, and you want to establish relationships with more and more investors independently and when you list on a crowdfunding platform, then go to GowerCrowd.com. That is all we do, is to build digital systems, digital marketing systems for sponsors so that you can find more investors and raise more capital. That's all there at GowerCrowd.com. And while you're there, be sure to check out the show notes page for today's episode, where you will find links to Kam and to Park Place Investments, where you can learn more about him and also see some short excerpt videos of today's podcast as well. All right, that's it. Now it's my great pleasure to introduce you to Kam Zainabadi at Park Place Investments. Kam, I'm so happy to meet you. Thank you so much for joining me today. I am absolutely, totally fascinated by, and I've got another screen up. Every time I look away, I'm not being rude around, I'm looking at your website over here. I am fascinated in Park Place Investments. Tell me everything.
Thank you.
An open question, open-ended question, right? Tell me everything. Let's go.
Thank you. Thank you so much, Adam, for having me on your show. I'm glad that I'm here and I could share some of my insight with you guys and talk to you about my company. Park Place, let me give you a little bit of context to the audience. I'm sure a lot of your audience may be already familiar with crowdfunding, but crowdfunding really kind of came to fruition with the Jobs Act of 2012, which went into effect in 2013. And it was the first time really since 1930s that companies could generally solicit private placements, which most of the time real estate offerings are really fall into that category, private placement. And that's really opened up a whole new kind of a industry. And there's really large players in this industry that are forming. It's still a relatively new industry, crowdfunding, especially in real estate, but the space is maturing. As you probably know, whenever there's a new industry, everybody jumps in. There's a lot of venture capital money that chases after a new industry. So a lot of companies start because there's money out there for them. It's a new idea, and that's really in 2013. That's when everything kind of started and as the industry is maturing, we've seen a lot of companies just not work because the model has to be a mature model. And from that arose a few really big players, and there's still several smaller players. But I think, from a business standpoint, that's really where the cycle has been. From an investor standpoint, is actually, I kind of jumped into doing some of these real estate crowdfunding deals pretty early because my investor journey started with investing in small um, single family homes when the 2008 recession happened. Then I kind of moved up because I was making good money, and the market was cheap. Back then I was in Riverside, Inland Empire, and the market had crashed. That was one of the epicenters. I started purchasing, and I moved up to fourplexes and got into commercial real estate just by chance because I could introduce in syndications. Although I consider myself kind of being not an expert, but knowing enough about active investing in small deals, I really didn't think I could invest in larger deals until by chance, I got introduced to syndicators. And that was a little bit of an aha moment for me because I didn't know such thing existed. I didn't know.
So first you were doing your own deals, were you, Kam?
Yeah,
You're buying singles and duplexes and fourplexes.
Exactly.
And then, so how were you introduced to syndicators? How did that come about?
It was just by friends. I was actually, it's very interesting because let's take it back. At the same time I was interested in real estate, I also thought it's very interesting to invest in as an angel because I was making money. I like the idea of alternative investment besides stock and bonds and private placement. So I kind of got introduced to angel investing, went to some meetings, and in that meeting, one of my friends introduced to one of his friends that was doing syndications. And I had no idea such thing existed because as far as I was concerned, commercial, like large buildings and purchase of those things were out of really my grasp because I was making good money, but there's no way I could purchase $30-40 million building.
Right. And so you started with a direct investment with a syndicator, did you? And then how was that done? Was that done in person, or was that done through one of the platforms? Just describe that first event to me.
No, my first syndication deals were through in person. There was no online I didn't know anything about online platforms. And, that's so I kind of learned about syndications. I was an LP on a couple of deals and it was doing well. I mean, the deals are doing well. And at the same time, what I learned was, it's really not a good idea to get into this type of property investing without really knowing what you're doing, because these are each of these properties to manage them is almost running an IPO or a small business. I mean, you really have to know what you're doing. And especially if you're going to go into this type of investing with a group of people, right? I mean, I never dreamt about purchasing something like this on my own or a few people. But then syndications really kind of, when I heard about it, I learned about these syndicators, learned about it, kind of vetted their background, saw the deals they were doing. I said, wow, this is really amazing that I could get double-digit returns, really good tax benefits, and still be exposed to commercial real estate. So that's how really the syndication my investing syndication started. Now, as far as crowdfunding online, that was again by chance because sometimes you type in things on Google and things pop up like advertisements. And I saw Fundrise. I mean, I don't want
remarkable how that happens, isn't it? You type
it's amazing
into Google and how do they know?
Exactly. How do they know? That's true.
All right. So so you type something in and Fundrise shows up. So what piqued your interest when you saw that?
Well, I mean, again, that was an aha moment. I said, wow, first of all, I didn't know what this is all about because I just got a couple of pitch lines on the Google text. And I said, let me click on it. Then I said, wow, this is very interesting. I didn't know about any of these regulations. I didn't know that this is kind of a whole new market and a new industry. And then I put one and one together because I said, wow, these guys are kind of doing the same thing that syndications are doing, but they're doing it online. And so I started looking at, then from there, I learned about real estate crowdfunding. I kind of, when you Google that, several big companies show up and some small ones. And that's how I kind of started investing.
All right. So now I'm dying to learn this. This is what I want to hear from you. So now you're online, you've discovered Fundrise. and presumably, and you tell me who, I'm not going to put the words into your mouth, but you tell me, saw a couple, three others that were strong in the industry, presumably, kind of stand out. You said there was some main ones and then there was some lesser ones. Describe what you saw then and how you became inspired by what you saw to form Park Place Investments. So tell me what you saw and what was that eureka moment? Aha, I should do something here.
Absolutely. So, so I looked at these sites, and the sites were very, they're all VC-backed sites. They're very professional. They, they have a model, right? I mean, they bring really large number of, almost I would say, institutional grade investments and to the average person, right? I mean, some of them have to be offered for high net worth individuals. Some of them don't, depending on the site and the regulation they're following. But I loved it. I mean, I thought it was a great idea. However, one thing I kind of thought it was missing was the fact that it wasn't very democratic in the way the deals are vetted. I think, the model has to have certain level of vetting of the deals, a due diligence. And understandably, there's always a fear, what if a deal goes bad, especially if you're highly marketing or even are investing, co-investing in the deal as a company with a syndicator or developer.
So what do you mean not democratic? Explain that to me a little. What do you mean not democratic in the way they are vetted? Explain that a little.
Well,
the way the deals were vetted.
Well, I think more of maybe more egalitarian, the way that, I always take it from an investor standpoint, not from the company standpoint, because from an investor standpoint, I think I do want the deals. I want a large amount of deals that I'm sophisticated enough at this point in my real estate investment career that I think I have ample opportunities and information to be able to find the right investor versus the right syndicator investment to invest in or not. And I really don't need the amount of vetting process. It's always a balance, right? On one hand, you, an investor such as myself, we want to be able to see multiple deals, right? 50, 60, 70 deals and be able to choose from them. On the other hand, obviously, from a company standpoint, you want to make sure the deals you're presenting to the investor, especially if it's truly a non-accredited investor, you really make sure these deals are in tune with, the projections that you're
exactly. So let me actually jump into that a little bit. This is what I'm interested in. So what are your criteria actually for allowing someone to list a deal on the marketplace?
Well, we definitely have an internal due diligence process with the investment committee. I mean, it's a long list, including background checks. But as far as the type of vetting we do is definitely not as stringent as some of the larger companies. And that goes back to the mission of our company. Mission of Park Place is to create something like a LoopNet or an MLS for the syndicated marketplace. And that's really the ultimate goal. We are not here. And one of the advantages we have, which I think is an advantage, is we're not bound to VC money. We're here. I'm self-funding this. I want to create a marketplace where it helps both the investors and the syndicators. There's a lot of syndicators that are locked out of those crowdfunding platforms because of either their amount of experience, or the amount of deals they've closed, or just the metrics of the deal. And this goes back to why I mentioned the larger sites have very stringent criteria, which fits their business model. However,
let's drill down on that. This is a very important point, and I totally understand what you're saying. Actually, that's what I thought. That's why I really wanted to talk to you, because I do think that this is an interesting niche in the market. So the big sites, and you've not mentioned any names. That's all right. I'll resist the temptation as well. You're welcome to if you want to. I've no problem. Everybody knows who you're talking about anyway. But they have 100 sponsors will come to them and they'll say yes to one. And of that, they will then drill down with 98 levels of due diligence to decide whether or not they're going to allow a deal on the site. So in short, it's very, very difficult to get listed on the site. From the investor perspective, therefore, if they believe in the integrity of the process, they can rest assured or be more confident, let's say, that a deal has been screened. Mm-hmm. Now, but what that also does is it means that 99.9 maybe percent of deals don't get seen. So that's the gap that you're filling, isn't it? Tell me, tell me, what are the criteria? For example, if I wanted to post my deal on your site, is there a process, or can I self-post it? And then what is it? Caveat. Gosh, my Latin isn't it caveat emptor? What is it? Buyer beware. What is it?
Buyer beware, sure. No, I understand what you're saying. Originally, our idea was to create a site where a sponsor could list a deal, and they still can. You could go through the process and actually list your deal on our site. But then we do have a one-on-one interview within sponsor, making sure, to learn about the sponsor themselves, what they're all about, learning about their previous experiences with syndications, how much, for example, what's their, how much assets they have under management, what's their exited asset under management, what specific type of asset class within that, within the framework of commercial real estate they really specialize at. And then we get their documents, or their legal documents, including their PPM. It has to be a 506C deal for us to list. So we come across a lot of sponsors that are very interested to list their deal. However, as you know, still most of the deals that are syndicated in real estate are still 506B. Last numbers I've checked was around 80 to 90%. So
just for that one guy out there that doesn't know what that means, what is the distinction between those two?
Sure. So 506B, well, these are all Regulation D exemptions, and this is one way to syndicate a real estate, and this is the most popular one with most syndications. 506B is when it's an offering that's, you could have about 35 non-accredited investors on board as investors. And the rest of them have to be accredited after that 35 limit. However, you can't advertise this, and that's what's called "quote unquote" general solicitation. The investors that you gather or you pitch the deal to, you already have to have a pre-existing relationship with, and that's 506B, and that was the most common one. And and going back to what I mentioned about the Jobs Act in 2012, when it was passed, it introduced Title II, which was 506C. 506C, the advantage of 506C is you could advertise your deals, and that was and that was really the starting of crowdfunding, really, in real estate. But some more specific about 506C, the disadvantage to some level is that you can't have any non-accredited investors, and also the accredited investor check can't be self-reported. It has to be verified through a third-party verification site or a CPA or a tax.
Okay, got it. Perfect. So somebody lists on the site, and by the way, I do think this is an incredibly creative option you've got. So I think it's absolutely fascinating.
Thank you.
So somebody lists on the site, and you then follow up with a phone call, and you give them an interview. So a couple of questions on that. You've described the investor process, right? So the investor has to go through a third-party verification process to be accredited. And is that actually, well, let's talk about that later. On the sponsor side, so you now have this interview, and I presume it takes about as long as you and I are talking, I mean, half an hour, an hour or so. You go through some checklist questions. So to what extent, two questions related to that. To what extent do you verify what they tell you, number one, and to what extent do you add any kind of grading or opinion or some kind of scoring, if at all, to the projects on the site?
Okay, so we do a background check using, we use Thomson Reuters Clear, so we have that. We also use our CoStar to look at some of the doing background check on the assets they have. So those are kind of the two things we do. The rating system, we have it internal because we can't have an external rating system, because if it's tied directly to the way our platform is, in the eyes of SEC, we cannot, how would I say, rate one sponsor better than another one, because we're really a bulletin board. So we have to be very careful the way we do that. However, having said that, I think there is a need for a rating system, and almost like an S&P or Moody's, to create it for syndicated deals. And and that's something that certainly another company could come in and do it. I know there's another company that somewhat looks at these crowdfunded sites, their deals, and does a subjective assessment based on kind of the ratings of the crowd, like Yelp almost. And that's actually very beneficial. However, having said that, I think how would I say it, look at I always use the stock market as an example, right? So I think as private offerings are really becoming more public, right? That's what the intention, ultimate intention of these Title II and Title III, which is CF exemption, is to publicize quote unquote private offering. So honestly, at some point, it shouldn't be called private offering anymore, because when you're introducing it to the crowd, you're kind of creating a whole new public sector, right? And what's better model to use and the well-established stock market and the public offerings that we already have. So we don't have to reinvent the wheel, right? So the way I look at these larger crowdfunding sites, and they're in a different life cycle of their company, and they're all almost invariably have to go to this cycle of creating a fund model. And that's almost a mutual fund. I would say the mutual funds are to the stock market as I would say, kind of these companies are to syndicated deals. They don't invest in every single offering. They kind of they leverage their knowledge and their investor base and their capital to invest across several securities or assets. However, that's one model, but there's another model, right? What about creating a marketplace like the New York Stock Exchange for private offerings? And
I suppose the big difference is that you can't trade. This is a one-way direction.
That's coming. That is definitely with blockchain. I've talked to 5 or 6 companies. I don't want to name them, and I'm sure you know about them because I've seen I think we're all kind of fans of blockchain, and that's coming already. That is secondary offerings marketplace is definitely going to blossom as the industry matures, as crowdfunding industry matures. There's no doubt, because it's almost like evolution, right? There's laws of evolution, and then there's laws of business. When you create this new industry, it takes decades, but it's going to go through certain determined cycles. So we want to be in a position to create a marketplace for certain type of syndicated deals. We want to be almost the exchange for it, right?
So Kam, actually, let me ask you a question here. So I want to, there's a few, I know we're going to run out of time. We've got a load of things that I want to ask you, because I think it's absolutely fascinating. I love this stuff. So I've got 3 kind of key topics that I wanted to cover. One, so we talked about the sponsor, and they listed it. Are there any criteria for the kinds of deals or the size of deals? The location, like what kind of criteria do you have for the deals themselves? Because you mentioned on the big sites that you said they're mostly institutional grade deals. So just describe what, for us, any sponsors out there listening, what can be listed?
We've had several offers outside of the United States. We're keeping away from that. We want to be geographically within the United States. I'm bound by SEC laws. We don't want to go beyond that. As far as geographic location, really, any state is fine. As far as the deal itself, we definitely look at the PPM. We want to make sure that the investor's protected as much as we can. As far as this is not a deal that really is something like again, there's a lot of criteria. We don't want to. We have an internal criteria. Make sure the PPM is solid. Make sure the investor is protected as much as we can. But again, we don't advertise that we're not here. We're not a rating agency for the investor. I think ultimately what distinguishes us is the investor has to discuss the deal with the sponsor. We don't create the financial ecosystem.
What I meant was the apartments, retail,
I see.
office. If somebody wants to raise 50 million or 100,000, like what are those kind of basic criteria?
I gotcha. No, I mean, we're open to any asset class within commercial real estate. Having said that, I think most of the fact that hospitality service has taken such a big hit in the COVID, I think most people would stay away. I mean, there's just not that many deals right now in hospitality. And if there are, they're kind of, distressed sales that we don't want to deal with. There's mostly multifamily. There's funds. I think funds really are something that's becoming more and more prevalent in syndications. And that's a natural cycle also, because if you think about it, a one property, a one-off deal, you have a finite amount of time to raise capital. Well, fund is evergreen. So crowdfunding really lends itself well to that. We have both debt side and we have equity side. We have a sponsor that has created a bridge fund. They have a bridge fund, and we have debt on that side. The beauty of that particular fund is it's short term. It's a bridge, so investors could realize their return their principal and their returns faster.
And there's no size limit on the size. If somebody comes to you and they want to list a deal that's raised, they've got a $500,000 deal and they need 100,000. I'm pulling a number.
No. I mean, I don't think so. But then again, I mean, if they're only trying to raise 500,000 for their entire capital, is it really worth it for them? I mean, I'll be surprised if they have a 506C.
Okay, so now of course that begs the question. What is your financial model? So a developer sitting out there listening and an investor, what's it cost?
Sure. So, because, going back, because I'm funding this myself and we want to create a really, as I said, democratic egalitarian system, I don't charge anything right now. And I know that this is always begs the question of what is the future? How are you going to make money, right? Well, there's many ways, plans to make money off the site. One is obviously listing a deal and charging just a listing fee, which you have to walk a fine line when it comes to SEC also, because we're not a broker dealer, so we cannot charge on commission. And that's also important because we don't want to charge commission because of the fact that we want to be a marketplace. We don't want to advocate one deal over another one. So the business model we have right now is let's build partnerships. Let's create a platform that meets a need. And I know there's a need because so many sponsors have come to us and there's a need. Let's create these partnerships. Let's create an ecosystem. And the first part of the ecosystem is create a marketplace where sponsors could list their deal. Second part of the ecosystem, which is in the works for us, is create a directory for sponsors. So let's say we're okay with a sponsor not listing their deal on our site. However, maybe the sponsor wants to list their company on our website. And we're okay with that because, again, we're a democratic model. So we want to create, number one, a marketplace. Number two, a listing directory of the entire syndicators across the United States, whether they're large or small. Number three is then start to monetize it if we can. But I think this is my goal. This is my mission. And to that ends, we're not charging anybody anything. And
okay, so now while you're thinking, and I know I'll tell you, you and I are in the same business in some regards, Kam, seriously. I build stuff. I see if people show up. If they do, I figure out how to make a living out of it. So I know exactly what it is. Basically, if it doesn't work, that's okay. If it does, we'll figure it out. There's value there. You're giving a lot of value to the market. Kudos to you for that. So how do you find developers? Here you are on my podcast. I actually called you You didn't call me. So what are your proactive? I want to learn. I want to hear this. What are your proactive efforts? How are you marketing? Because my whole business is digital marketing. So how is Kam marketing to find and attract developers? And then after you answer that, I'm going to ask the same question about investors. So let's start about developers. How are you finding developers? How are you getting them to your site?
Sure. Well, at the beginning, it was difficult when we started. And when I say beginning, this is October of last year. I mean, this is not long ago. I became very involved with LinkedIn. I started, going on podcasts. I enjoy it. I like talking to people, bounce off ideas. And honestly, a lot of times when we talk to individuals, for very intelligent individuals that are in the industry, I kind of, things change in my mind too. Like, you start formulating and maturing those ideas. So I mean, it started with podcasts, being very present in LinkedIn. And the fact was, the sponsors thought this was a great idea. I mean, honestly, I started this platform as an MVP, which in tech world is minimum viable product. It was not, we just wanted to throw something out there at the beginning and see how it works and make sure the idea is not crazy. And the sponsors liked the idea because of the fact that they know about crowdfunding sites, and some of them have even tried to be on it, and they know it's very difficult. It's not an easy platform. So then they're stuck with advertising themselves, and there's not really a platform that brings everybody together. So, I mean, that's how it started with LinkedIn, podcasts. Our platform, kind of grew from there.
And then how are you finding investors? I'm just going to run a little search here. I know it's terrible to do this on the fly, isn't it? But
no, absolutely.
A little bit more information might give me an answer. But go on, tell me, how are you finding investors? What marketing are you doing for them?
Well, number one, we started because, at the beginning, we just went to our friends and family and high net worth people that we knew they were a credit investor. We got them online. We got them signed up for our site. That was about 50 or 60 to begin with. Since then, it's been organic. Sponsors list their deal on our site. They share their deals. Investors come on board. They see the site. So we've grown up to 300 investors right now, which is not a small feat because you probably know the hardest part of the entire industry is how to get investors onboarded. We are creating a whole educational model. That's going to go online soon. We already have some on our blogs, but we're going to really make that robust because as we're learning, like what does it take for investors to actually check out the marketplace and sign up, and part of that is just providing education for them, because I know a lot of sponsors are doing this, but I think one thing that's interesting is every investors love the education. They like to hear it multiple times from multiple different people. And sometimes, as like when you went to college or school, one teacher, the way they say it is better than somebody else. And no matter, you could hear the same thing, a physics problem 10 times, but if you find the right instructor, and we're going to try to do that on our way, the way we think it should resonate with our investors and get more investors. And those are the ways, and also marketing, So those are, on Facebook, Instagram, marketing our content, marketing our educational material, marketing the deals.
Are you doing paid ads? Are you doing
yes, for Marketplace for sure. Yes, we are.
How are those working out for you?
It's working as far as we are getting. The issue is this, like with Facebook and Instagram, one of the stumbling blocks is because the way they, the criteria they for housing or for any real estate business, it's somewhat difficult to target directly to high net worth individuals because of the way some of the regulations on it has to be under housing, and when it's under housing, it's difficult to get high net worth individuals. So it's a work in progress how to really target our ads towards high net worth individuals, and we're learning how to do it. But so far, we've gotten several investors from Facebook ads, definitely, but not as much as we want, because we can't really target it to them exactly because of the way Facebook handles real estate advertisement.
I would love to talk to you for hours. Let's wrap up. I've got 3 sign-off questions. And the first one, these are kind of what I call lightning round. What are your key daily habits that make you successful?
I think number 1 is waking up very early in the morning, waking up, exercising, reading as much as you can, not just the stuff that you like to read, but things that are actually necessary to read for your business and for your success. And talking to your personnel, talking to everybody in the business. We're startups, so we're very small, but I think you keeping that attitude up, and as the company grows, having always, for an employee, have a direct communication with the CEO, and never having like too much bureaucracy.
And you're a doctor. You're actually a physician.
Yeah.
A physician. So you have a day job. Just as a totally aside thing, don't worry, none of your patients are listening. Don't worry about it. But are you hoping that this will take over one day, maybe, and you'll put down the scalpel and the pills and just be working on real estate? I'm not sure what kind of doctor you are. Maybe you're a dentist. Yeah. I don't know what you do.
Well, that's a great question. No, I love my job. I love real estate. I love finance, and I love learning, and I like technology, and I like angel investing. So I'm surrounding myself with things that I love. And honestly, like, I'm happier when I do everything I love. So as far as starting a company, I mean, I have successors, and I want them to run the company. I mean, I honestly, the way I envision myself 5 years, I want to be a physician part-time, do what I love. I mean, I love providing service to people. I think, waking up every day and helping somebody is amazing. As far as real estate, I mean, everything else is like, I want to start something and create a legacy and hand it off to somebody and be part of the board. That's my ultimate plan with Park Place.
Oh, nice.
At the beginning, I can't do that.
You want to be chairman of the board. Yeah.
I have to own my vision. I mean, ultimately, you have to own your vision. And when you own your own vision, and nobody's going to own it for you, and when it becomes successful, then you could create a legacy, right? Hand that down to somebody that could implement it better than I can, right? And we have people in the company that I know they can do that. We just have to wait for the company to reach that level. As you know, with exponential growth, is at the beginning, you're not going to get much for a long time. And then when it takes off, it will take off.
Second question of last 3, try and keep them brief. What's been the hardest lesson you've learned in real estate?
Hardest lesson in real estate. There are a lot of smart people in real estate, and the hardest lesson is the fact that it's a tough field. It's definitely it's a field that's I haven't had. The one lesson I've learned with any investing, I think, not just real estate, hold it long term. I think, so I think in real estate, the lesson is like, real estate is the best investment because you take the emotion out of it. It's not liquid. So, like when I bought stuff in 2008, the market still was going down. I'm like, oh my God, what am I doing? Why did I do that? But the lesson was, keep on going, let it go. Don't look at Zillow every day for your price, how much your investment's going up or down, right? Exactly. Like, you're not richer today or yesterday, or it's just the fact you hold on to it. And I mean, that's the beauty of real estate. You take the emotion out of it. And I mean, the hardest lesson is that just invest with confidence and leave it behind for a while, just
play the long game. I love that. Just great. Make the investment and then forget it. Someone else is working on it anyway. All right, last question. Maybe that dovetails into it, but for all the investors who are listening, who have not actually invested in a crowdfunded real estate deal yet, what would be your advice to a new investor?
Oh, absolutely. This is very important. know your sponsor. When you get on the call, when you're on Park Place, you contact the sponsor. Make sure to ask them, what's your experience? If you haven't done that many deals, maybe you come from a bigger company. Maybe you come from a private equity side or asset management side that actually has experience. So your experience of the sponsor, ask them as much about the deal as you can, and research the deal yourself, and make sure to read the legal documents, because you want to protect yourself. And every single metric that a sponsor is going to tell you, it's an educated guess. It's a projection. That's why they say target returns. But you want to make sure that what they're talking about actually makes sense. So I think it's difficult at the beginning. Do your research. There's tons of education both on Park Place and crowdfunding sites and other sites, that if you just type in your site, exactly, learn what IRR is, learn the difference between equity multiple and IRR. I mean, when I got into it, I thought IRR was just every year you're going to get money back, like cash on cash. Like, even though I thought I was a pretty sophisticated investor, this is a whole new field, right? This is like investment banking metrics, IRR. I mean, the average investor doesn't know much about this stuff. So I think education is very important. And at the end of the day, make sure that your expectations are in line with the sponsor. Make sure that that these are, if a sponsor tells you this is going to be 5-7 year strategy, make sure that you're okay with that, because this is not the stock market. And real estate is a long play, and it's a good play, and it's a good investment, as long as your expectations are not that, I'm going to return all my equity back in a couple of years. It just doesn't work that way. Unless maybe 1 out of 50 or 1 out of 30.
Exactly.
It's the way it is. So,
Kam Zainabadi, founder, Park Place Investments. Thank you so much for being on my podcast today. It was an enormous pleasure to meet you.
Thanks, Adam. I really appreciate it. Thanks for your time.
That was Kam Zainabadi, Park Place Investments. If you are a real estate professional and you want to raise more money, either directly from investors or by listing on Park Place Investments or anywhere else, then you need a good digital marketing presence, and that is what we provide for you. Go to GowerCrowd.com, learn more about how you can do that. There's a massive amount of training on the site. It's all free. Some of it is premium, but go ahead, sign up for the newsletter. That's actually where I met Kam. Find out what's going on in the world of real estate crowdfunding every Wednesday, and get some educational content from me on the weekends. All right, that's it. Thanks for listening. And thank you, Kam Zainabadi at Park Place Investments. Fascinating business model. Very keen to hear how that works out. Thanks for spending your time with me today and for telling us all about it. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.